Hello everyone, thanks for coming. And in this week, we discussed some further topics on stock options and also the strategies for trading options. So the factors that affect option prices falls in the following categories: the current stock price of the option, the strike price of the option. So for a put option, the higher the current stock price is, the higher the price of the option will be, and also the time to expiration. Usually the price of the option decreases when the time to expiration decreases. Also, the volatility of the stock price. Usually, if the volatility of the stock price is large, which means that the price of the stock fluctuates much, then the price of the option will be higher. Finally, the final factor will be the dividends that the stock pays. We have the upper bounds and lower bounds for the option prices. For instance, for a call option, the upper bound is the stock price, and the lower bound is the maximum of 0 and the stock price minus K times E2 minus RT. So this bound ensures that there's no chance for arbitrage. However, for a put option, the upper bound would be K times E2 minus RT, and the lower bound would be the maximum of K times E2 minus RT minus the spot price and 0. We also have a put call parity, which means that if we invest in a call option and put the money in the bank, the outcome will be the same as we invest in a put option and buy the stock buy the stock on spot. As for the strategies of trading options for a non-dividend paying stock, and if one holds a call option, the optimal strategy is to never exercise the option early. For a put option, early exercise is possible, especially when one holds the underlying stock and thinks that the stock price might go up in the future. So for a European option, when it comes to dividend paying stock, we also have the put call parity, which is that the price of the call option plus the present value of the dividend plus K times E2 minus RT equals to the price of the put option plus the spot price. For the American option, the equality becomes inequalities because we know that for an American option, the price of the call option is always greater or equal to the price of its European counterpart, and also the price of a put option is always greater or equal than its European counterpart. We have different trading strategies for options that are used in practice. For instance, we have a bull spread. A bull spread is to long and short a call at different strike prices, and this is used when one thinks that the price will go up. So if the price goes up, it could make an earning from the bull spread, but the earning is not as much as a simple put option, call option. But also the investment would also be smaller than a simple call option. We also have a bear spread. The bear spread is a combination of long and short put at different strike prices. And this is used when one thinks that the price of the stock might go down. We have box spread. The box spread is a combination of a bull spread and a bear spread. We also have different spreads. The butterfly spread, which is a combination of 3 options. The calendar spread. The calendar spread is a combination of two options with the same strike price, but with different expiration dates. Finally, we have the diagonal spread, which is the most complicated case. We have some further combinations of different trading strategies for options. For instance, we have a straddle, which is to buy a call and a put with the same strike price and date. We have a strip, which is to long position in one call and the two puts. We have a strap, which is a long position in two calls and one put. And the difference is that for using a strip, one thinks that the probability that the stock price will go down is higher than the probability that the stock price will go up, and the fluctuation of the stock price is great. For using a strap, one thinks that the probability of going up is higher than the probability of going down. We have a straggle, which is to take a long position in a put and call with different strike prices. There are many payoff functions that could be approximated if one just using the options and the different combination of taking a long or short position in options. So there are many technical details which may not be so relevant of our class materials, but you can check the materials by yourself. Thank you.